Today, we are going to be looking at a property in Jacksonville, Florida that was built in 2016, is already rented with a lease in place through 2023, and is ready for immediate purchase. No waiting list or construction delays. We're in the game.
Game on.
All right, we're officially live on Facebook for the Thursday edition of the Not Your Average Investor Show, the JWB Rental Income Property of the Week. I'm your host, Pablo Gonzalez. With me, as always, the man I affectionately call GC. Genius concepts, because he generates cash flows, because he's a great co-host, and because his name is Gregg Cohen.
I can't look at you when you do that, by the way. It makes you crack up. It makes me crack up. Hopefully, it makes you all crack up, too. But great to be with you all.
I thought it was that I said affectionately is what made us crack
I think
up.
It is, because you get this glimmer in your eyes as you're like looking at me as you're saying
that naughty glimmer. I get that naughty glimmer going in my eyes.
Oh, man.
Where were we? We're on a show right now. Welcome to the show. As we like to say, this is presented by JWB. And if you want to know about owning rental income properties in your portfolio, you're in the right place. If you want to know about best in-house practices for rental property investors, property management practices, I messed that one up too, you're in the right place. And if you're a real estate professional that wants to get an edge in the Jacksonville market, maybe a couple extra opportunities for you and your clients, you're in the right place. Next place to go is chatwithjwb.com. And now it's time for my favorite part of the day. You know what it is, GC?
I love it.
It's the roll call, y'all. We got Drew Barnhill in the house. Hello, everybody. We got Carl Thompson. Good morning, everyone. We got John Henning. Good afternoon, all. We got G-Stars back in the house. G-Star is our guest producer today, guest community manager today, because to be perfectly honest, the Philippines are going through a really tough hurricane. So heart goes out to Joanna, our usual community manager. Hope she's well. And let's get back into it here. Send her some good vibes, though. Leo's in the house. Good morning, Leo. Michael Kubata is back. Welcome back, Michael. Good morning, everybody. We got Lee Bishop, the MVP of the Not Your Average Investor Show community. He's in the house. We got a name that I haven't said in a while, Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
Welcome back, Marilyn. I don't know what we've been doing without you. Who else we got? We got Ken Moline. Good morning, Ken. He's the patriarch of the first family of the Not Your Average Investor Show, as we like to call the Molines. Who else we got out here? We got Dean Curry from Ohio. Welcome back, Dean. We got Carlos Santos Lopez from Lima, who is chiming in with increased interest rates, right? He's on a scent out here. He knows what's going on. And who else? I'm scrolling through the chat, everybody. We got Hervé Francois in the house. Hervé in the house. Oh, he put that himself. So I already said that. Welcome back, Hervé. Good to have you, buddy. Haven't seen you in a couple of days. And we also got Marge, who's also helping out too, community managed, so that we build some redundancy and be able to help people as much as possible. That was the roll call.
There's a couple of folks that are on that scent over there as far as talking about what the Fed's doing. Let's recognize a few of those. I saw Drew said that the Fed is going to stop buying bonds.
No surprise.
Yeah, there we go.
Drew knows what's up in general. Lee Bishop increased interest rates also. He knows, he's generally a guy that knows what's up. Dean Curry. Yeah.
Well, we're going to talk about what reducing bond purchases means. Eventually, increasing interest rates means for all of us, why we should be paying attention to this. Again, as soon as I get that call, I'm waiting for the call.
The call. I think you mean the we got breaking news today.
Breaking news.
Greg, GC, what's the breaking news?
Well, shocker, we're going to be talking about what the Fed is doing today and the worst kept secret of what breaking news is going to be. But I think this is really, really impactful. And listen, I'm not an expert in monetary policy, but I know enough to be dangerous, and I understand the cause and effect for you as a rental property investor. And so I just wanted to talk big picture about what the Fed just announced and what it absolutely means in relation to the best time to be buying rental properties and how it will affect your return on investment going forward. What we have been going through as far as monetary policy is something we've never really experienced before. All right, monetary policy, if you go through history, is more of like controlling interest rates, right? To control the money supply. Well, when the Great Recession happened and the Fed came up with new ways to pump more money into the economy, one of the things that they did, which they had never done before, is buying bonds and buying mortgage-backed securities. So the Fed actually buys bonds and buys mortgage-backed securities so that they can increase the money supply, right? Lowering interest rates for them was not going to accomplish everything they wanted. So they said, what's another tool for us to increase the money supply? And the reason they want to increase the money supply is because the economy was really in a tough spot.
Okay.
Right. So they came up with this brand new way of doing it called quantitative easing, which really is buying bonds and buying mortgage-backed securities. And when they go and do something, it's go hard or go home. Because I looked this up just before the show. The Fed now, since they began this new policy, I don't know when it was, 10 years ago, 15 years ago, somewhere around
the
there.
Quantitative easing policy.
Yeah, quantitative easing, buying the bonds. Mm-hmm. The Fed now has a balance sheet of $8.7 trillion with a T. $8.7 trillion that they have put into the money supply. What the Fed also has said is that when they are going to reduce the money supply, when they are going to monitor the amount of economic activity and make a decision to reduce the money supply, they have a very organized order of operations to do this. The first thing for them to do is to reduce this bond buying program and reduce the mortgage-backed securities buying program. That is their first, it was the last lever they wanted to do to increase the money supply. It's also gonna be the first one that they reduce. They're gonna do that, and then they are going to raise interest rates. Why does the Fed now want to reduce the money supply? Well, it's called inflation.
Inflation, we talk about it.
Right, the Fed is there to monitor inflation. They want to keep an inflation rate somewhere around 2%. And right now, inflation, according to the Consumer Price Index, is over 6%. So now they're saying, okay, well, what is my order of operations? What am I going to do? The news that just came out today or yesterday is that the Fed is even going faster at reducing the amount of bond purchases than they even said a month ago or 2 months ago. So they are going stronger in reducing the bond purchases. I'm going to give you some numbers here. They were purchasing $120 billion in bonds and mortgage-backed securities in November, right? We are in December right now. So in November, they were purchasing $120 billion. They dropped that down to $90 billion for December, which we're at right now. And they just came out and they said they're going to start to buy $60 billion in January, which is an insane amount of money, right? Again, this was never a part of monetary policy before. Yep. And they have plans to, this is what people call tapering. They have plans to taper off the purchases at an aggressive rate, even going to next year. The reason I go into all of this detail is because this is the clearest sign that they are going to raise interest rates, and it's going to happen often from this point forward. Right? Before, when people are like, well, I know interest rates have to rise. I know they can't stay this low. Well, this is the Fed absolutely coming out in articles. In fact, do you want to bring that article up right now? It's from CNBC.
I did. I just, I showed it a little while earlier while you were kind of dropping that news line.
Perfect. Right? The Fed comes out and they say, we're not just going to raise interest rates one time in 2022. They said that they're planning on raising rates 3 times in 2022. They also said they plan to raise it 2 more times in 2023 and 2 more times in 2024. Now, there is this alliteration that I've been saying on this show for the last year or 2. I'm prepping you.
I know what it is.
You know what I'm going to say.
I know what it is. I know what it is.
People are talking about pricing and all of this. Is that the best reason to buy now and all this? I think this is the best reason to buy, but I think it differently than what others think. For me, the deal is different. What's the deal? The deal is the
deal is the debt.
The deal is the debt. Your ability to lock up debt, smart debt at 3-4% interest rates and have that there for 30 years allows you to build generational wealth. Well, the reason I'm coming so strong with all of you and telling you that this is the time to be adding to your rental portfolio is because that deal's going away. That's what this is talking about, right? If you just think, right, they just said that they're going to raise interest rates 3 times in 2022, 2 times in 2023, and 2 times in 2024. That's 7 rate increases over a 3-year period. Okay. If all they raised it was 1/8 of a point, which is doesn't have to be that little, it can be more than that. If all they had to raise it, or were going to raise it, was 1/8 of a point, that's almost a full point that interest rates are going to raise over the next 3 years. minimum,
Yep.
according to what they're saying right now.
Yep.
Well, you know, I love that we're going to jump into the property of the week, because I want you guys to think about what your returns on investment are today at today's interest rates. And then we're going to plug in 1% higher, because that is what's going to happen going forward. And I want you to see the return on your investment and how it's affected. This is why I continue to say this is the best time to be buying rental properties. Not so much about pricing. I don't get caught up in short-term pricing, right? Pricing, I do expect to be higher next year than this year, and that's great. But the debt, the deal is the debt. And the fact that you're no longer going to be able to secure debt for 30 years at a 4% interest rate is very real. It's telegraphed right now by what the Fed is doing.
That's heavy stuff, man. I mean, I feel like we've talking about this idea that the chickens are going to come home to roost, right? Like on a macro level, the news, you talk to anybody, you know, we talked to Andy, we talked to John Burns about this like outlook of fiscal policy, because inflation is going crazy and the Fed is going to at some point step in. We talked to Alex a couple months ago and they said, you know, maybe it's not as bad. We think this is temporary. This is a major, major announcement of this is what's going to happen. And then even more important than the announcement of we're going to raise it 3 times, it's show me what you're doing, not what you're saying, right? So you're saying that this quantitative easing, the change in quantitative easing is the signpost. It's the first domino that will fall for this domino rally that's going to be the raising of interest rates. And that's the first step that they're taking. So they're doing step 1.
Absolutely. It's in process.
It's in process.
The writing is on the wall. How this is ultimately going to affect all of us as real estate investors, the cost of our debt is going to go up. And it's going to go up aggressively, because it is aggressively so low right now.
Yeah.
Right.
Yeah.
Inflation at this scale that we're seeing right now is not good for our country. That's why the Fed is here, and they're going to take these steps. And your opportunity to benefit from these incredibly low interest rates is going away.
Okay, that makes sense. We got Noah Randari. Noah, I think that's a new name. Welcome to the show. Good to have you here. And
Welcome,
you're
Noah. Chatting
with us here in the chat. Just so everybody knows, we love interacting with you in the chat or in the Q&A, right? It's a lot easier for us to bring the question onto the show if it's in the Q&A bucket, because that stays. And as you see, that chat moves really, really quickly. And also, if, you know, the purpose of the chat is because we want you all connecting and making friends and being part of the community, right? So if you want other people to see what you're typing in the chat, you got to change the default setting from just host and panelists to everyone, so everyone sees it. That being said, we caught it because we got Gina and we got Marge in the house that are helping us moderate this stuff. And Noah has a question. Don't you think raising interest rates will increase inventory and bring housing prices lower?
Great question, Noah. So we have to have perspective about where we are with inventory levels and how that relates to home prices, right? We talk a lot about, Noah, it's great to have you as your first time on the show. I hope you come back. One of the things we talk a lot about is this concept of monitoring supply and demand in the housing market. We do that through a measurement called months of inventory, and something that I report on quarterly during our calls here, and we report on it monthly internally in JWB. It's just this concept. Like, if you're a business owner and you have stuff to sell, if you have really low supply and you had a ton of sales last month and you got people lining up outside your office to buy your stuff, you're going to have pressure to increase prices. And the other effect is true as well. If you have a ton of gadgets in your warehouse and you didn't have any sales last month, or a very low number of sales last month, and nobody's picking up the calls to buy your stuff, you're going to have pressure to decrease your prices. And historically, this is how we measure short-term pricing in real estate as well. It's like any other business. Historically, if you have a months of inventory measurement between 6 to 7 months, that would mean that you would see normal home price appreciation. Normal home price appreciation in Jacksonville is a little bit over 4%. So if you have a measurement of 6 to 7 on months of inventory, you'd see normal home price appreciation. The way that you calculate this is just really simple. Ask a realtor friend, or if you're a real estate professional, go on the multiple listing service in your area and go and see how many active listings you have on the multiple listing service, and then see how many sales closed you had last month. If you have 6,000 houses on the market and you had 1,000 properties that sold last month, you have 6 months of inventory. All right. When you're lower than that, that would indicate higher than normal home price appreciation. And that's where we've been living for the last decade. And That's why you're seeing higher than normal home price appreciation for the last decade in Jacksonville and a lot of markets out there. So to answer your question, right now, our months of inventory is the lowest I've ever seen it. It's below 1.5. Been tracking this every month since 2014. We've been low between 2 to 3 months of inventory. I thought that was the lowest I was ever going to see it. We've never seen it this low. There's a severe lack of supply in the housing market, and that is what is causing increased pricing at a level we've never seen before. So your question, do we see interest rates increasing housing inventory? Some, little, right? The biggest driver of this is actually builders building inventory. That's why you're seeing so much land being purchased and built out right now. That's why you see housing permits, building permits at historic levels right now. So yes, your point is valid that you're going to see inventory levels go up a little bit when you raise interest rates. It usually doesn't happen the same year when interest rates rise. Actually, historically, it happens a little bit later because the economy is so strong at that time that it usually takes a little bit of time. So your point's valid, but pay more attention to the number of building permits and the housing construction being completed, because that's what's going to eventually get us closer to equilibrium, which is closer to 6 to 7 months of inventory. And how do I see pricing working? Because you got me on this tangent, Noah, I'm going to keep going with it. Because we are lower than 6 to 7 months of inventory, it's going to take us a long time to get there, that I see us raising interest rates next year, and I see us having higher than normal home price appreciation in 2022.
There you go. Classic GC 7-minute answer. The economic concept of interest rates raising, affecting pricing is a solid concept, Noah, to your point. The key driver that tells you what's going to happen in the short term is this months of inventory statistic. We are way below months of inventory. Traditionally, therefore, for the foreseeable future, prices will continue to rise. What's really affecting this whole thing, because there's a glut of supply versus a large demand, thanks to macroeconomic forces that are bringing people to Jacksonville and this attractive economic environment. What's really going to be affected is the long-term ROI on investing properties, because people that want to move here to live here are still going to be moving here to live here. Mm-hmm. It's just the rental property buy and hold investor that on the macro level, that's what you need to be looking at.
Yeah, I think it will affect demand much more on investors as interest rates go up 1% or 2% or whatever it's going to go up.
Yeah. Than the velocity of houses being sold.
Yeah, exactly.
All right. Well, with that, we're already 20 minutes in, and now we're going to magically whisk ourselves away to our property of the week. Week. Let me know in the chat if it's clear coming in as we magically whisk away to 5664 Baywood Terrace, Jacksonville, Florida, 32211, one of your famous zip codes. Purchase price of $280,000. It's a 4-bedroom, 2-bathroom house with a 2-car garage. It's got a lease for 2 to 3 years of $1,625. And we always go to this right here. This total monthly cash flow with estimated conventional financing of $137 a month, and total ROI with typical financing of 7.74%. GC, I look at this house. It's pretty. I like these numbers. They're normally what we're seeing, but what do you love about this house?
I love the fact that this house is ready to close right now. Like any renovated home, this house actually was built in 2016, so it looks brand new. We actually would call this a renovation. Any renovated home has an inherent advantage to a new construction home right now, because you don't have to wait 4 to 6 months for it to be built. And if we piggyback off the original conversation here about what the Fed's doing, they're already signaling that interest rates are going to go up in 2022, right? If you have the ability to buy a house right now and to lock in your interest rate right now, that is an inherent advantage. And you can do that with renovated homes. This one, look beyond the beautiful picture there. This is technically a renovated home. It's available to close on when a client puts it under contract, which is different than when a client puts a new construction home under contract.
Got it. So is this house specifically ready to, can somebody go to chatwithjwb.com right now and get this house?
No.
Okay.
No. The way that we do the show, especially for Noah and those who are new to the show, is I do a little bit of prep work before every show.
Got to do it.
We want to run a tight ship around here. So I prepare our properties of the week about a week or two in advance. And things move very quickly on our sales floor here. So this property actually has been purchased. But the reason why I continue to show this as a learning opportunity for you is because JWB has other opportunities that are exactly like this. So the concepts I'm teaching here, buying a renovated home right now, being able to maximize your debt advantages there, you can give our office a call. You can go to chatwithjwb.com, and there are 4 to 10 other homes that are exactly like this one. So if you buy into the concept, we're going to be able to replace the widget, which is the property. And so that's what we would do. Even though this one technically has already been purchased by a client, there's another one waiting for you right there.
There you go. So something that you said there is that you have available inventory, right? Like we're talking about these like months of inventory, a total glut of inventory, other markets being on total waiting list, other, providers here in Jacksonville are on total waiting list. This is something that not only do you not go into a waiting list because you get to pick your property that's in pre-construction, but you actually get to purchase a house that is already existing and you can close it ASAP.
Yes. And we have been focusing on trying to create more renovated home opportunities for our clients to get them to be able to take advantage of it. If you think about the properties of the week for our veterans of the Not Your Average Investor Show community here, you guys have seen a lot of brand new construction homes. And we've talked about this. This is the natural state of things right now. You have to wait 4 to 6 months from the time you agree to buy it until the time you can actually close. That's the natural state of things. Well, we now have other renovated homes that are opportunities for folks to be able to buy. We've been able to source them in a number of different ways. And again, juxtaposing, SAT word. Goodness, I almost forgot SATs.
You got the juxtapose right. Gosh, you missed the really easy one.
Missed the easy one. Juxtaposing that next to what we know interest rates are going to do even makes it more valuable for folks to be able to buy a renovated home.
Yeah, and it's been pretty clear. So it feels like on the POTW for the last 2-3 months, it's been a lot of new construction homes. Right. It's obviously new construction. And I feel like we've been on a streak of renovated homes for the last 3 weeks. So it sounds like y'all kind of probably ran a really great commercial in the local market and got a bunch of you got a new kind of restock of inventory of renovations that are now available. And right now it's a good time.
Yeah. And it's, my job here on the property of the week is to show you what I believe is the best property to highlight. Right. And when there's something that I can highlight for you that I see a big opportunity, I'm going to try to put that in front of you as often as possible. That's why you've seen more renovated homes over the last 2 or 3 weeks, because it's even more time sensitive now than it was 6 months ago.
Cool. So let's go into education mode. We talk about the opportunity and whatnot. What we also talk about here on the show is the difference here. You mentioned it. This is a widget. It's a JWB, right? Like what people are buying is not this pretty picture. It's the opportunity to get this total monthly cash flow and this total ROI. So talk to me about the estimated conventional financing total monthly cash flow at $137. What does that represent?
So when you're looking at total monthly,
let me pause you real quick because I haven't said this. If you go to jwbinventory.com, you can download this sheet and you can fiddle with it. Gina has also shared it here in the chat so that you can just download it straight if you're with us live. But if you're on the podcast, go to jwbinventory.com and you're going to see what we're talking about. GC, total monthly cash flow. Go.
Noah is killing it too. He said, I'm not there. Let me check it out. I love the interaction, Noah. Thank you again for being here. And for all of our new guests as well, joining the community. All right. When you're looking at buying your own investment property here, you look at 2 things. First, you need to look at monthly cash flow. Then you're going to look at your return on investment. We'll talk about monthly cash flow and what that should represent to you, right? First thing, take a step back and just think about how awesome it is for you to be able to invest in something that delivers a monthly dividend check to you. That's what this monthly cash flow is, right? You go into the stock market, it's really rare for you to be able to get a dividend. It's usually not as high as this, right? It's really, really rare in many asset classes for you to receive monthly cash flow. You usually put your money somewhere, you let it sit, and then eventually maybe you get a whole bunch back. Yeah. Well, this is an asset where you put your money in something and immediately on a monthly basis, you start earning a little bit of cash, a little bit of monthly cash flow. Don't get so enamored about what that number is for the amount of monthly cash flow here, right? Because $137 is great because it's positive. Right? It's not going to change your life, right?
Correct.
$150, $200, whatever it is, it's not going to change your life. Your goal here is to be able to have an asset that pays for itself every single month. And if you can get something positive on top of that, that's awesome. You are not going to accomplish your goal by flow, no matter where you're buying. I mean, sure, there's a few exceptions to it if you bought 100 properties at one time, but most investors need to look beyond just the cash flow to really accomplish their passive monthly income goals. So it's a little high level, how we think about monthly cash flow. It's there. It's kind of like the entrance to the dance. It's entrance to the dance of buying rental properties. It needs to be positive. Specifically, what that is it's taking the gross monthly rent, so the amount of rent that we collect for you from your resident, and then we take out all the expenses that happen every single month, like principal payments on your loan, interest payments on your loan, property taxes, insurance costs, property management fees. All these things happen every single month. You can't avoid them. And so what's left over is, $137 here. And if we take it one step farther, think about yourself accomplishing your passive income goal, whether that's a goal of $5,000 a month or $10,000 a month that you need to retire or go on a trip or donate to charity or whatever it is. It's going to be more than, it's going to be more than $1,000 a month typically for people. Well, if it's more than that, you need to be buying more than one property in order to accomplish that. Your portfolio is going to be larger. Well, this $137, this positive cash flow should represent risk mitigation for you. Because if you start to think about this, if I'm going to accomplish my goals in rental property investing, I have to have more properties. I don't want to go negative on one property. I don't want to go negative on 3 or 5 or 10, right? Then that's a liability, right? Then I'm paying money for that every single month. So the goal here is positive monthly cash flow, gives you risk mitigation and gives you scalability. Now you can get to 3, 5, 10. You can start to accomplish some of these big goals that rental properties can do for you.
There you go. Makes sense. And, we talk about this week in and week out, right? A couple of things to point out that made it land for me 2 years ago when we started the show and I knew absolutely nothing is, number one, this cash flow, once you started talking about it as like scalability, as like the ticket to the dance, right? Like I see it as an NFL fan, right? Like quarterbacks need to have a certain level of arm strength, but the guy with the strongest arm isn't necessarily the best quarterback, but they can't have below a certain level of arm strength to be able to be an elite quarterback, right? So this is that like arm strength kind of metric. It can be the higher it is doesn't necessarily correlate with how great the whole investment is. It's just what you need to have in order to be able to think portfolio and not think, all right, well, I'm going to lose a little bit here and then I'm going to cash out 20 years later. That's going to limit you, right? Because you got to have the positive cash flow. And the other thing that you told me is that when you build, and I went through this when I became an investor as well, but when you build your portfolio, you're building it out thinking about this estimated cash purchase total monthly cash flow. Because at some point, as you're owning this thing, your resident is paying it down, you are amassing equity. And at a certain point, it's going to be, by the time you're ready to retire or, maybe you pay it down ahead of time, you are at this like 1,140, right? So it's a number that rises as time goes on. And it's generally right now what it is just your typical monthly experience.
It's a beautiful thing. You've got two things working in that direction. You've got your resident paying your loan down for you. So eventually you have zero loan. And then that would equate to that, roughly $900 net, $1,000 net, right? On a monthly basis, depending on the type of asset you're buying with JWB. And then you've also got what's been going on this past year, rent prices going up.
Oh, yeah.
Right. Generally rent prices go up with inflation. Yep. Inflation's been happening. Rent prices have been going way up over the last year. So that net number of what it will actually perform for you in 30 years is actually gonna be a lot higher than 1,000 or 1,140 or whatnot.
There you go. All right. So before we go into the difference between that and the estimated conventional financing total ROI, which, spoiler alert, it's the 5 profit centers, we've got a question from a member of the community here, been here before, all the way from France. Anonymous Attendé asks, where does JWB get their inventory?
Great question. I think our reach is very far and wide in France. We must have a direct line to France. I think that's probably the most prevalent foreign country we have.
Oui.
Oui. Well, thank you so much for the question. Where do we get our inventory? We have built relationships here locally that allow us to source inventory at a rate that other people just can't. We have been the biggest buyer of infill lots and renovated homes in Jacksonville for a long time. I actually was just talking with my acquisitions team, and we are 8 properties short of 1,000 properties that we're purchasing this year. 8 properties short. We may even be there because that was a couple of days ago. And so that is it is the lifeblood of our business. The lifeblood of our clients' returns is having access to this inventory. And so that's what we do. We plan. And again, I should point out, right? We're buying 1,000 properties this year. We're not selling 1,000 properties this year. We just sold our 500th property this year a week or two ago. So we'll end the year somewhere around 500, 550 properties sold. You know, we are buying 1,000 this year because we are preparing for inventory for you in future years as a client. This is what we've been doing for 5-7 years now. We've been buying 700 properties a year and selling 350 to 400, right? And so we continue to stockpile this inventory. So that's the real reason why we have inventory today. It's future planning. It's thinking, understanding where the economy is, where the market is, aligning our resources, using our private lending program to have the funds to be able to buy land, sit on it for a few years so that you all have inventory for the future. And it's something that we have to be really great at because we are so committed to the Jacksonville market.
One of my favorite storylines on the show is the forward-thinking operational capacity and planning that JWB does, right? This idea that you guys have been stockpiling properties for a moment like this. You continue to stockpiling properties because buying a property today is going to be better, just like you're telling investors to do. It's better to buy today than it's going to be to buy tomorrow.
Like,
so you're putting your money where your mouth is. It's such a clean business model, and you know I'm nerdy about it, but I'm not going to get too crazy because we got another question from Lee Bishop, MVP of the community. Greg, just curious, if you pay cash for property, why is cash flow not $1,600 each month minus 10% management fee, but cash flow only shows 11? That is quite a difference each month. Can you talk about this, please?
Yeah, let's go to the cash tab. I think it's great for us to get more and more familiar with the evaluations, right? So on these evaluations, you're going to see 3 different tabs at the bottom. There it says analysis cash, analysis non-recourse financing, and analysis conventional financing. So, and you can all adjust these at your leisure here. So when we look at the cash purchase there, on a monthly basis, we're looking at that $1,625 coming in. That's right. Then if we go down to expenses, we're seeing property taxes, which are $265 a month for this property. We're seeing homeowners insurance at $58 a month. And then we're seeing our property management fee, which is equal to 10% of the rents that we collect. And you take $1,625 minus that $485 there, and you're left with $1,140.
There you go. Easy peasy. That's math. All right. So let's go to estimated financing total ROI. GC, explain to us the 7.74% and how we got to think about it.
All right. So when you're thinking about investing in this rental property that you're considering, again, number one is cash flow. That's entrance to the dance. Your determination if it's a good deal. Is it a good deal?
It's good deal.
It's a good deal.
It's a good deal.
If that's positive, right? Because you're not going to accomplish your goals just by cash flow, right? If all we had in this asset class was cash flow, I would not be doing this show. I would not be a real estate investor. I would not have left my corporate job to start this company, right? I started to understand all 5 profit centers. Most investors in rental properties only understand one, and they totally miss the boat. They only understand positive cash flow. So you got to understand more than just one. The 5 profit centers are what makes this an unbelievable, the ultimate asset class in my professional opinion here. So when we're looking at total return on investment there and you see 7.74%, what I'm talking about there is how hard is your money working for you, including those profit centers, beyond just cash flow, right? The other profit centers are, well, let me quiz you, see what you got. What are the other profit centers other than positive rental or positive cash flow?
We got cash flow. We got debt pay down.
Yep.
We got tax savings.
Love it.
We got home price appreciation.
Nailed it.
And we got inflation hedging.
Inflation hedging, bro. Yeah. You know more than 99% of rental property investors out there. And everybody here knows more than 99% of rental property investors.
It only took me 150 episodes to do
it. That's awesome. That's awesome. So it's those 5 profit centers that separate this from every other asset class. That 7.74% takes into account net rental income, takes into account tax savings, takes into account principal pay down. We haven't gotten to home price appreciation yet, and we haven't quantified inflation hedging. So it really takes into account, for what you see right now, 3 of the 5 profit centers. It also takes into account the expenses that happen from time to time. They don't happen every single month, but they happen from time to time. Examples of this would be maintenance costs, vacancy costs, tenant placement fees, closing costs. These are costs that do need to be evaluated when we're thinking about how hard your money is working for you, but it's not going to be there every single month. It's not factored into your monthly cash flow. When you take all of the bad things, the expenses I just talked about, and you include 3 of the 5 profit centers, what you're left with is an incredible representation of how hard your money is working for you with the things that we have a direct amount of control over as your property management team. And so when you see 7% there, 8%, compare that to your other asset classes. Historically, the stock market produces at 7 to 9% returns, but it's not monthly cash flow coming to you. It's not those extra tax savings. It's not principal pay down. All they're thinking about is appreciation of the stock.
Yep.
We haven't even talked about home price appreciation yet, and we're still at 7 to 9%, which paves the way for us to look at that incredible upside of what home price appreciation is. It's not the reason to invest, but that's what takes you from a risk mitigated investment to incredible upside, which is why I love rental property investing. Got it.
So you're kind of explaining it a little bit different than you normally explain it, but I like where you're going with this, because this 7.74%, those three profit centers are all contained within the boundary of the property.
Yeah.
And you control within the boundary of a property. That's the only thing you're promising.
Yeah.
But JWB plays on another scale, which is you're also vertically integrated all the way into the community, and you are affecting the macroeconomy to the point that you can. And within the macroeconomy is these other 2 profit centers, which is inflation hedging. You don't control that at all.
No.
And a little bit of home price appreciation based on what you're able to do as far as housing stocks and urban development and the different things that you're doing.
What we're doing downtown.
What you're doing downtown. Yeah, correct. So that being said, I would imagine that, can you quantify, like, how would you even begin to build around inflation hedging for this thing? Is that even possible?
You can do it a number of different ways. The easiest way is to think about what inflation does for you, right? Inflation, if we just say inflation is 3%, that means that my dollar tomorrow, a year from now, is worth 3% less. All right. It's the same dollar. I can buy 3% less of stuff.
Yeah.
Right. My dollar's the same, but all a dollar really is how much stuff does it allow me to buy?
Yeah.
Right. So if everything around you goes up 3% in a year, then this same dollar that I have is devalued by 3% because I can buy 3% less stuff.
Got it.
Last year. Now, think about what this means as far as debt. Okay. If you have smart debt on your properties, you've got a set amount that you pay every single month for the next 30 years for your loan. All right. Now, 1 year to the next, my dollar is devalued by 3%. That means that if as inflation happens, I get more dollars. Okay. They necessarily can't buy more, but we all take home more pay generally in inflationary markets. So my dollars coming home increase, but the debt payment for me stays the same, right? The debt payment is not inflation protected. The debt payment stays the same no matter what inflation happens. So as inflation happens, we tend to bring more dollars home. They can't necessarily buy more stuff, but we bring more dollars home and we pay that same debt down every single month, every single year. What happens is, even if you do nothing well in rental property investing, it gets easier for you to pay that debt down every single month, every single year as inflation happens. How did I do on explaining that?
I think that's pretty good. When I think of like the value of a dollar, I think of my usual store of value that I think of, and I think of a McChicken. It's 99 cents. So,
yes.
So let's say when you're equating to debt, I'm gonna try to land this plane here.
Love this.
Kind of what you're saying is, in the future, McChickens are going to go up at 3%, right? Like they're going to be in a year, it's going to be $1.02, right?
There's not going to be a dollar menu.
There's not going to be a dollar menu. That's right. It's going to be the $1.25 menu.
Yeah.
Good call. And I kind of keep up with that because wages will technically, you get a 3% inflation cost of living raise or whatever.
Yeah.
Good companies do that. Right. Debt is kind of like saying, well, I'm I'm gonna lock in the price of these McChickens at 99 cents for this long. And as your wages increase, you're still going to be able to be getting those McChickens at that
you
price.
Locked in the price at 99 cents for the McChickens, where everything else on the menu now costs $2.
Yeah. Yeah. So there goes my girlish figure. Sure. All right. Got it. Okay.
That was awesome. Well done.
Just trying.
That's huge.
McChicken economics. I call that.
I love that. Write that down.
McChicken economics. All right. Talk to me about appreciation rate, GC. How do we look at it, right? We got it at 0% here, but we've been talking about it going bananas lately. Explain this to me.
I love this, but Denny Davey just put in the comments here, Dollar Tree is no longer a dollar. I saw this press release, the Dollar Tree store was coming out and justifying how it was in their customers' best interest that they were no longer going to have things for $1. That is $1.25, as Denny points out here in the chat. That is what is going to happen. That's what inflation is. Imagine if you can go to Dollar Tree and you're like, hey, listen, I'm just going to take out some debt, but you know what? Everything's going to stay $1 for me only. That's kind of like what you're doing by taking smart debt out. You get more money because we're all a part of this inflationary environment, but the cost of the debt stays the same. It gets easier to pay it down. That concept is so powerful. So I hope we keep talking about it.
Okay. I'm pretty sure we're going to keep talking about it. Right. Yeah. I don't think inflation's going away.
I don't think so.
Appreciation rate. Yeah.
All right. So appreciation, a lot of people get confused about appreciation. If you go,
wait, you know what? There's a question by Michael Santorios.
Okay, perfect.
We value questions. You're taking time out of your day to be here. We want to answer your questions. Keep them coming. Michael Santorios asks, Gregg, can you expand on how you came up with the tax savings figure?
Yes, absolutely. I think it'd be best for us to go to the evaluation.
Which one? Analysis conventional?
Yeah, let's do conventional financing. All right. So let's zero in there, right?
To where?
Actually, let's get out of the numbers first. Let's talk about tax savings first, so we don't get confused about the numbers here. You can even stop the screen share there, right? Let's do this. Tax savings. What we're talking about here is the fact that this asset class has an incredible amount of tax advantages compared to any other asset class. We are able to write off as rental property investors a lot, right? Interest costs, property taxes, insurance, property management fees, closing costs, actual maintenance costs that happen on your property. You name it, there's more than that, but you're able to write all that off. You know, that's the reason why you have this gross rental income coming in, but at the end of the year, you're not taxed on the $1,600 a month or $1,625 that we're getting on this property. You're not taxed on that full amount. You're taxed on a much lower number because of all of these write-offs that happen, which is a beautiful thing, right? What those are cash write-offs. Like, and I'm not an accountant, right? So consult your CPA. I'm probably not even using the right terminology, but I'm just simplifying it for myself. Like as a business owner, when I spend money on things, like I spend money on the studio, right? When I spend money on this, I paid for this, and then I get to write it off as an expense for JWB, right? That's cool. I like the write-offs, but I had to spend the money on it. There is a write-off for rental property investors that is, we haven't talked about yet, that is beyond just a normal cash write-off where you just spend the money and then you get to write it off. It's called depreciation. Depreciation is a non-cash write-off. Like how cool would it be for me to say to you, hey, listen, you don't really have to spend the money on anything breaking in your property, but I'm just going to reduce your tax liability.
Yeah, sounds good.
That's what depreciation is. The IRS has said that properties depreciate over 27 and a half years. So whether or not anything breaks in your property, you take that write-off, you divide the building value, which we'll go here in just a second, divide it by 27 and a half. I'll walk you through it in just a second. But you're left with this write-off that you get just simply for owning a building, whether or not you actually had to spend the cash. And that's what you don't see in other asset classes. You don't get that in the stock market, right? You don't get that in bonds, right? You don't get that in annuities. What that does for you is it allows you to defer your taxes, which is a huge growth strategy. We all love the idea of a 401k or an IRA. Well, a rental property, because of depreciation, almost can act like a little mini tax deferral investment, right? It can almost act like a little mini IRA or a little mini 401k. And please don't confuse this with like thinking that this is actually a 401k or an IRA, but the tax deferral component of it is what we all love so much about our 401k. You're able to write it off, right? You're not eliminating the taxes. You're deferring them until later, and money in your pocket today is worth a lot more than money in your pocket later because it can be invested in other things.
Okay.
Yeah.
All
I've been going
right.
kind of deep today, right?
You've been going deep. You've been passionate about it. I see it emanating from your.
I know. I'm kind of sweating here, man. I'm like into it.
Over here.
I know, man.
All right. So depreciation is a non-tax event write-off. It's something that you're not spending money every year to get the benefit from it. So it's a non-tax event write-off, unlike the idea that if there's a tax rebate on buying a Tesla, I got to go buy a Tesla to then go get a tax write-off.
Right. Yeah. You typically have to spend money in order to get the write-off.
Yeah, correct. This is I didn't understand the whole tax deferment thing there.
Okay. So let's just say that your write-off here is $4,000. All right. Because of depreciation, the IRS is going to allow you to incur an expense of $4,000. Let's say that you earned $4,000 of net rental income, just to be simple. All right.
Okay.
So at the end of the year, your net rental income, not including depreciation, was $4,000.
Okay.
That's what you would be taxed on.
Okay.
Right. Times your tax bracket is what you would be. That was the tax that you'd have to pay.
Got it.
Right. Let's just say you were the 30% tax bracket. That would be $1,200 a month, or excuse me, $1,200 for the year that you'd have to pay on that $4,000 of income.
Got it.
Okay. Now you have this beautiful non-cash write-off of depreciation. Okay. Let's say that's a $4,000 write-off. You earned $4,000 of rental income, net rental income. You now have this $4,000 write-off from depreciation. What's the amount that you're actually taxed on that year?
Zero.
Yeah.
All right. Yeah. That's pretty.
By the way, dude, we don't rehearse this ahead of time.
Yeah.
So when I throw like questions at you, I think it's awesome that you're answering, that you allow me to ask you questions like this. Like, this is incredible. Man.
If I didn't have Gina and Margin here also moderating the chat, it'd be a lot harder.
It's awesome, man. I've been on the other side, and some of our show guests here or other folks know, yeah, Greg, what's 10 times 10? And I'm like, I don't really understand this concept. I'm like, I don't know, 50, So yeah, so it's zero.
Yeah.
Okay. You're not paying that tax this year in this example. Do you eliminate the tax you have to pay?
No. Okay.
No. Later down the line, you'll have to pay the tax.
When you sell the property? Okay.
So when you sell the property, whatever your purchase price your sales price is that you sell the property, you also have to take into account how much you depreciated the asset. So if you bought it for $100,000, but you depreciated $50,000 worth of value over that time period,
and you sold it for $200,000, you would have a net profit of $150,000. All right, now I'm getting
tax gain of $150,000. You'd pay it later on.
Got it.
So the way that this relates to an IRA or a 401k is kind of doing something similar, right?
Yeah, now I get it.
You have money in your IRA today, you invested in something, you don't pay the tax on it today, but eventually later on, after that asset grows, when you're 59 and a half, and you start taking that into your personal bank account, you have to pay the tax on it later on. So it's somewhat similar. You see what I'm saying?
Got it. Yeah. And then you can use that positive cash flow to invest in other things so that it can compound more in the meantime. And you make money. It's how rich people do it, folks. We got Denny Davis in the chat saying, while you do have to pay taxes on that depreciation eventually, if you hold the home through the full market cycle of 10 to 20 years, you are paying taxes on the depreciation down the road when the monies are worth much less due to inflation. Again, inflation hedging, but you get the tax benefit today when the dollars are worth more. Or never sell the house. Never have to pay that tax on the depreciation you claim. I like it. And Drew Barnhill says, now you guys are talking my language. LOL.
Love it. Love it. Danny, Drew, thank you guys for contributing. You guys bring the fire every single show. So thank you guys for being here.
It's great. And Michael Santoro says, unless you do a 1031 exchange at the end of the 27.5 years, right? Which is another can of worms we can go down.
You don't even want to get me started on that. I will talk till 3:30.
Yeah, he's going to soak right through this shirt, people. All right, GC. So then let's explain the appreciation thing. Why is appreciation here at 0%? And if you claim that it's a profit center, why we got it at 0%?
Yeah, well, it's flat out. People don't understand how appreciation works. And this is also a combination. Were you staring at my bicep?
I was very, very impressive. Very impressive.
People don't understand about how about home price appreciation works.
I thought you were about to say that people don't understand how good a shape I'm in.
No, that's not where I was going. Oh man, forgive us, guys. Forgive us. Thank you guys for humoring us. Yeah, people don't understand home price appreciation. If you think about the run up from 2001 to 2006, people thought home prices appreciated all the time. Mm-hmm. Home prices never went down in value. And that's how people made decisions, right? Think about 2007 to 2011, the market dropped 35% in Jacksonville and in other places in the country. And then people were like, dude, I'm never going to evaluate home price appreciation again. I don't know if home prices are ever going to come back, you know? And from then on, people have had these cash flow blinders on. All they think about is cash flow. They don't think about any of the other profit centers. And the problem with that is that if you actually hold on to properties for a full market cycle, what you'll see is that the biggest contributor to your return on investment is not cash flow. It's home price appreciation. It's home price appreciation. So if you are going into choosing your market or choosing your asset class or choosing your property or your property manager or your buying timeline, how long you're going to hold it, and you're saying, I'm not even going to factor in home price appreciation, you are leaving a tremendous amount of money on the table, right? Like comparing it to other asset classes, I don't even know if rental properties make sense unless you consider all 5 profit centers,
Correct.
right?
Correct.
Like that's how much I think about this, right?
Mm-hmm.
But when you understand all 5 profit centers, the equation starts to change. So in home price appreciation, what has been shown is if you go back, and I actually just pulled some incredible stats that I just shared with Pablo right before the show. We're going to come up with a way to share it and have you guys see this, all of the data that I look at. You know, the home values go all the way back to 1982. They are cyclical. Cyclical, you probably heard before, people say home prices are cyclical. That means that things come back to the norm. And if you know what the average appreciation rate is for your market through multiple market cycles, that's what we mean by coming back to the norm. It's going to be pretty close over the next 20 years if you look at what happened over the previous 20 years. And so in Jacksonville, the data actually shows, with this updated data that we're about to reveal, it actually shows that Jacksonville's home price appreciation rate since 1982 is 4.6% on average every year.
That's breaking news if you listen every week.
There you go.
Yeah.
The number prior to that was 4.3%.
Yeah, for my whole life, it's been 4.3%.
Well, there you go. Better data, longer data. You know, this comes from John Burns Consulting, so high degree of trust there. So now that 4.6% has a caveat to it. That is the long-term cyclical average home price appreciation rate, but that doesn't mean that's what it's going to be next year or 2 years from now or 5 years from now. You have to be in the game for a full market cycle in order to count on that. And so if we think about why we put 0% in here as a appreciation rate, a lot of it is, I don't know if you're going to listen to me, if you're going to stay as a rental property holder for 10 to 20 years. I don't know if you're going to hold on to it. If you are not going to hold on to this for a full market cycle, 10 to 20 years, I don't think you should be counting on home price appreciation, because then it becomes speculative based on the data. The other thing is that you compare this asset class to other asset classes, and for us to be able to deliver 7.74% estimated returns on investment without even talking about appreciation, whereas other asset classes like the stock market, all they talk about is stock appreciation, and they're between 7 and 9%. This has a really compelling argument without us even talking about appreciation for rental properties to stand up and match and beat the stock market. So it can stand on its own 2 feet. The other and last part of why we choose 0% here is because my team is committed to under promising and over delivering. We want to be able to have you come in with realistic and conservative expectations for how we're going to handle your money. And we want to be able to give a whole lot more money back to you than you were expecting. And quite honestly, not promising home price appreciation gives us an ability to under promise and over deliver. And that's happened a lot, especially over the last 5 to 10 years, when the market has gone up 9 to 10% per year on average, and 19% last year.
Yeah, I was about to say, yeah, I am one of those folks, right? I bought a couple of properties at the beginning of this year. He showed me that 19% number over this year, and if I could do a better cartwheel, I would have. But
we'll have to get that on video.
Let's get that on video. All right, so let's say I am an investor that has fully bought into everything you see on the show, for example, moi, and I'm going to hold it for 20 years, 4.6% appreciation rate. It goes from 7.74% to Well, bam, 25.24%. It jumped up 16 percentage points. What's going on there?
So that's the beauty of smart debt. Need to understand that when a value goes up, when a market value goes up 4%, when things appreciate, your home goes up 4% over the year. That doesn't necessarily mean that's your return on investment from that appreciation. It's a factor of how much you put down, how much down payment you have. So if you have an investment that goes up 4%, if you have a house that goes up 4% year over year, and you only put 25% down, your return on investment from that appreciation is not 4%. It's actually 16%. Because return on investment is your return over your investment, how much you put down, right? If you lower that down payment number, your money is working much harder for you. And this is not to say that we're going to go super speculative and start financing everything to the max, even if it doesn't pay for itself every single month, even if the interest rates are super high. Smart debt is an asset that pays for itself every single month when the debt costs are low and assets go up in value long-term. And so that's what we have in rental properties. That's why I love rental property investing. I don't finance my car, right? Financing my car is a low interest rate, but the value of that car does not go up over the long haul, right? Doesn't pay for itself either, unless you're an Uber driver, which maybe I'm not, right? So keep that in mind. Use smart debt in rental properties like this. And then what it allows you to do is, because you're in for a full market cycle, you're able to really quadruple your rate of return just from that appreciation because you're using other people's money.
The power of leverage. Show up every week and we will show it every week, right? It's the magic trick that made me understand the value of this whole investment thing. The idea that I can't put $25,000 down to get $100,000 worth of stock. Yes. But I can put $25,000 down to get a $100,000 home that appreciates as much or more than stock.
Yes.
Yeah. I love it, man. I love it. GC, this was fun today, buddy.
Dude, I appreciate you guys being here. Just giving me a platform just to wax poetic about this stuff. I love this stuff. I love you all being here too. This is great.
It's great, man. Listen, we never take for granted the idea that 27 people have been hanging out with us. The number's actually gone up as we've been on, which makes me think that going live on Facebook, people are joining in as it's happening.
That's awesome.
The podcast listenership has gone up. That tells me that you're sharing it with your friends. So that's really, really cool. Thank you so much. If you are listening to the podcast in the future here in your ear, join us on the show. It's a good time. You're going to make a friend somewhere in the chat. Probably Lee or Jen for sure are going to be your friend going forward. Huh?
How do they get there? If you're on the podcast, how do you get to the show? If you're on the show, how do you get to the podcast?
Go to nyais.com. That's notyouraverageinvestorshow.com. And you can register for the show and join us. Everybody that's here already knows that part, right? But this is for a friend who's listening in her ear somewhere in the future. We'd love to have you join us, be part of the fun. GC, I know that you're out next week.
Yes.
So this is our last show before Christmas. This has been an awesome, awesome year so far. We still got some shows coming up before the end of the year. So it's not the end of the year show. We got the fan appreciation show coming up at the beginning of the year. That's going to be really fun. If you don't know the fan appreciation show, check out last year's storytell and bring on people that have been a part of this. Would love to have you be a part of it if you show up. And what else, man? Oh yeah, you came to learn about rental income property investing. You definitely learned something today. You came to learn about property management practices. We talked a little bit about that. You learned about that today. We talked about the Jacksonville market, how there's a new historic shift in data, a whole bunch of cool things happening. If you want a personalized conversation, you want to know more, go to chatwithjwb.com, get yourself into a conversation, and I'm good here, buddy. You want to send us off, man? I love our community, right? Like I want to wish you a Merry Christmas here live on air because I love you, buddy. Merry Christmas, this is that time of year, man. So
it's a special time of year for us to reflect on the things that are most meaningful to us and the people that are most meaningful to us, and you all are most meaningful to me, right? This is a community that's really built out of nothing, right? It was just an idea, and the fact that we have 30, 40, 50 folks that spend some time with us twice a week in the middle of a workday means so much to me personally. I know it means a lot to you, Pablo. So Merry Christmas, happy holidays. I really, really appreciate you guys trusting us and sharing a little bit of your lives with us here on the show. And we're looking forward to an incredible year in 2022 with the Not Your Average Investor Show. So
yeah. And before you say goodbye, that doesn't mean we're not here on Tuesday. I'm going to be here Tuesday. We got Ashley Hatton coming on, who is the ultimate hang. Tell me what you think of Ashley Hatton, GC.
Well, she's incredible. She's an incredible part of our client service team, a portfolio manager. So for you as a client, many of you are Ashley's clients, right? As JWB, you get paired with a portfolio manager, and Ashley is there to deliver the maximum return on investment for you and to make your client experience mind-blowing. And so we're going to be talking a little bit about both of those things with Ashley. If you want to hear what it's like actually on the inside of JWB beyond me, right, to talk about the people that are actually working with our clients, the success stories we've been able to have, some of the pain points that our clients have, Ashley is an incredible resource for you. And I know you guys are going to love the show on Tuesday.
All right. We will see you on the next one on Tuesday.
See you, everybody.
Merry Christmas, buddy.
You too, buddy.